Kristina Hooper is joining us, the Chief Global Market Strategist at Invesco. Kristina, thanks for joining us while you're on the move this morning. Let's talk big picture here first, because Ben and I were just discussing some of the hints of like a reflationary trade in this market. Do you believe it, or is it false hope?
Actually, I think we could see a fairly solid fourth quarter. This is an environment in which we're likely to see more volatility. Certainly, U.S.-China news flow around trade is going to move markets up and down. We're also going to see other events moving and other factors moving markets up and down. But I actually think it's going to be a decent fourth quarter.
Now, are you speaking about the economic potential? Or are you speaking about stocks in general, kind of risk perspective?
From a risk perspective, I mean, keep in mind we have the Fed underpinning risk assets, and so that should be a strong positive.
What's interesting right now is you have both the expectations for the October cut still very much in line, but then a lot of these cyclical-oriented parts of the market showing some resurgent strength. The home builders at highs. The housing market's been doing nice. Now it's like even copper's trying to get a move on. The industrials are outperforming. What do you make of this, Kristina?
Well, it's interesting because one would assume that we are technically very much late cycle. However, the Fed has changed that dynamic by starting to cut rates. 2018, you could say we were legitimately late cycle, but now we might be in a very aberrant environment where we're seeing signs that suggest an earlier cycle within the late cycle because we're getting this monetary stimulus. So certainly an unusual environment where you could see cyclicals performing well because of an expectation of a resurgence in economic growth.
So this is so interesting. If we were having this conversation even as recent as 2 months ago, right, when bonds were making highs, everybody was rushing into gold in August like there was no tomorrow. This is now a market that feels like we can look forward to tomorrow because people are willing to buy economically sensitive companies. What tools are we going to be using, Kristina, to figure out if this is a head fake or if there really is potential for kind of a next stage of this growth?
Well, we certainly want to follow the economic data closely. And some of the recent U.S. economic data has not been too positive, in particular U.S. retail sales and industrial production. But a few data points does not a story make, and so we're going to want to follow that closely. But it seems clear that one key theme is that there is more monetary stimulus being thrown at the global economy, more monetary stimulus being thrown at the U.S. economy, and for certain countries, there's more fiscal stimulus being thrown at them, and in particular, I would focus in on China and especially India.
So, is there a potential that we have a shift in terms of regional leadership? The U.S. has been the best house on the block story, the driest, shirt story, all that stuff. Is the U.S. dollar's breakdown in your mind signaling that regime is shifting?
I think it's too early to suggest the regime is shifting, although we do know that over time there is a reversion to the mean and valuations are stretched for U.S. stocks. So we certainly want to have slightly lower exposure to U.S. stocks and start adding exposure outside the U.S., especially emerging markets equities. They had a really disappointing run, but I would argue that there have been outside factors that have contributed to that, including balance sheet normalization. And so with the end of balance sheet normalization, that should end the liquidity suck for emerging markets, stocks and bonds, and could provide opportunities going forward.
If EM starts to look attractive, the dollar starts to weaken up, even though our typical kind of market 101 playbook is lower dollar, better for big caps, better for stocks overall. Kristina, what I'm curious about is the strong dollar has really been a good backdrop for equities. We've been making highs over the last year and a half. Even after savage sell-offs, we buy the dip. Does that excitement for U.S. companies fade if the regime now turns and creates opportunity for some of the beaten up areas around the world?
I don't think so, because we have to recognize that even within risk assets, there are those that are going to focus in on safe havens. And U.S. stocks represent something of a safe haven within the risk asset space. So I don't think that where the dollar goes, for example, will dictate the fortunes of U.S. stocks. I think we just need to recognize this is an environment where we need to be well diversified, and that includes within risk assets.
What if we track this back to the Fed? Because I like that you bring up and remind us that the Fed is being accommodative in the background. That's what we've heard from them. But we've also heard when Jay Powell talks about his reasoning for cuts, he says, well, it's not really us. That's what he's telling us the last two cuts, right? It's not us, it's everybody else. So if we have this shift where everybody else is stabilizing, will that mean that we should expect that this really is just a mid-cycle adjustment and maybe they'll play a little bit more hardball?
I think we should assume that. Better to plan for the worst, even though we hope for the best, and assume that this situation improves or at least stabilizes globally, and that the Fed is unlikely to offer much more accommodation. We're still in a far better place than I think we expected to be in terms of monetary policy when we began 2019, and that should still provide something of a tailwind for risk assets, even if it's not necessarily very powerful when it comes to impacting the economy.
Kristina, last point here is we once again have a big event today on the Brexit stage. U.S.-China seems like it's in a little bit of limbo right now, but are these still the crucial sort of deciding factors for what central banks are going to do? I mean, will we say if there's Brexit resolution, that makes Jay Powell's job a little bit less pressing? If there's China resolution, does it make his job less pressing?
Well, I think for Brexit, that's very much a Bank of England scenario where they're going to be on the front lines of making adjustments depending upon what happens. But certainly for the U.S.-China trade relationship, any kind of improvement in the relationship should take pressure off Jay Powell, who obviously feels some need to compensate when we do see a lot of negativity around the U.S.-China trade relationship.
All right, Kristina, always a pleasure to catch up. Really good stuff. Thank you. Always a pleasure.
Thank you.
Kristina Hooper is the Chief Global Market Strategist at Invesco.